Hello and assalamu alaikum everyone. Today we have to start with our second technique of valuing inventory basically or costing inventory that is known as our LIFO, last in first out. So the main concept here is that the inventory that was bought at the end of the year is preferred to be sold or used first. So this creates a problem. That is why this particular technique is not very preferred. The problem that it creates is that if you consider it in the market, that the inventory that you have kept as a safe side, as a stock inventory, as a thing that is used only when needed, is valued way lower than the market. So if we have to replace the inventory, it will cost us very high. What do I mean? I basically say, we'll take some example. I'm saying that we purchased uh, a bag of chips, let's say, on 1st Jan 2020 for 50. After that, we bought at in June 2020 a bag of chips for 70. Next, we purchased on 30th December 2020 a chips of 100. Okay, now you have three examples. In LIFO, they say we will consider first the option that is purchased recently. So we will purchase a good at 100. Okay. We are not going to use the good that is already available with us for 50. So this creates a gap, almost double. So that creates a gap that if I want to replace this inventory, this would have been valued at cost if possible. If we are valuing it at cost, will be valuing at 50. But when we are going to replace it or buy some new inventory in today's date, we have to give a 100 rupee value for it. So the difference is significantly higher in between the things and the cost. So it is less preferable. Other than that, the difficulty that we face is that in LIFO, the inventory becomes obsolete. What does it mean by obsolete? Obsolete basically means that the inventory that you purchased originally has been old or not able to be used in the current affairs due to its uh, technological uh, oldness or weaknesses that are overcome by the new models. We are not able to use it, whether due to its features that were old, not new. So it is a problem for us. So in LIFO, what we're going to do is basically in LIFO, we are going to use the inventory that is purchased the last, and we will keep the inventory that was purchased earlier at the last option. So let's see. LIFO assumes that the most recently purchased material are first. This results in higher cost of goods sold and a lower ending inventory value when purchases are rising. How is that so? It says, let's say, keeping this example in mind that we have or already doing. So if I am purchasing an inventory of 100 and I'm selling it for 120, is my cost higher? It is higher. Okay, my cost is higher. It should have been 50, but because of my technique of valuation, it is 100. So is the cost higher? Yes, it is. Now, the 50 I have kept, this 50 is still with us in the inventory. That means this inventory will be carried forward to the next year. Yes, it would. So would it be classified as closing inventory? Yes. So this 50 will be classified as closing inventory, signaling us that the inventory that is bought is of lower value, but in the market, the inventory is of higher value. So it creates a difference, so significant sometimes that it creates a negative impact on the financial statements. So this method is not preferred for this particular reason. So let's see the calculation. In this example, we are told that originally we bought, the example has been continued from the plastic. So in this example, they are telling us that we bought 400 units at the value of 60. The 24,000 units is the 24,000 value is in dollars and 400 units are. Then we issued some inventory that are 200 units at the value of 60 that we originally bought it for. So simple. Now we are left with 200 and 12,000 the value of it. But now the twist comes here. When we are buying 300 units at 70 value, this is a recent purchase. So next time when we are going to issue any inventory, we're going to issue it at 70. Let's see. So we bought 300 units at 70, it makes it 21,000. 21,000 plus 12,000 is equals to 33,000. So I'm writing it here from the red. 21 plus 30 is or 12,000 is equals to 33,000. Now, when we are issuing inventory, we are issuing inventory at the latest price, that is of 270, and the 200 units are issued at 70. So that makes it 200 into 70 is issued. Now here we are left with 200 at the rate of 60 and 100 at the rate of 70. That makes 19,000. So 7,000 plus 12,000, 19,000 is the total that is left. Now moving on, we bought some more inventory at the value of 80. So we bought some more inventory at the value of 88. So it makes it 24,000. 24,000 plus 19,000 makes it to 43,000. I'm writing it here. 24,000 plus 19,000 makes it 43,000. So now 43,000 is the value that is present in inventory. Now, are we going to issue at 70 or 80? Now we are going to issue at 80 because that was the recent purchase that we have in inventory. So here we are going to use 80 as our value and 16,000. Now what do we have in an inventory? We have in an inventory 200 units of a value of 60, 100 units at the rate of 70, and we have 100 units at the rate of 80. This is the bid on that we have right now. Okay. Now, if we have to issue one more set of inventory of 200 units, now what we have to do, we have to choose the latest options for us. We will choose 80 first. Now, because the 80 is finished, we are left with 70. So we will use 100 into 80 plus 70 into 100, and these both will be our options for our last inventory. So in that, we will be left with 200 into 60 inventory, and that will be a closing balance. So you can see here that we are giving 100 into 80, 8,000 plus 100 into 15,000. So value is 15,000. Their value is 15,000. If you're issuing 15,000 worth of inventory out of 27,000, 12,000 is left. So that is our closing inventory, closing balance of inventory. And if we add all the purchases that we have made, 15,000 plus 16,000 plus our 12,000. So that makes it 257,000. Okay, as written as well. This is the value of the inventory that was issued by the supplier. So this is very basic, very easy. You will go with a very smooth process of LIFO, as we are just using the inventory that was bought or purchased at the end and summing it all up. So according to LIFO, the key insights or the key things to remember are that LIFO results in a higher cost of material issued and a lower costing of inventory valued, which are not true and fair. If it was according to the market rate, we had no issues. But here the problem is that we are not operating on the market level. We are operating on our own. In the market, the inventory is expensive, but we are recording it in a closing inventory at a lower value. We see in the market that the inventory that was bought 2 months ago, the order that was taken 2 months ago, is not that expensive, but we are using the inventory that is expensive, and that will result in a possible imaginary loss. Let's say we took a contract 2 months ago and we estimated material at 50, but if we bought it after 2 months, it will be 70. If you have taken the contract at 60, are we having a loss if we buy the product at 70? Yes, we are. Of how much? 10. But actually, were we having a loss? No, we weren't. Did we have the inventory? Yes, we had. But due to the new purchases, it is going to have a negative impact on it. So I hope this is clear. Let's see the advantages and disadvantages. Advantages are inventories are issued at a price which is close to the current market value. So the current market value and the inventory prices are very near. Managers are continually aware of the recent cost in the market and for decision making because the costs being charged to their department or product will currently be in the market operating. So if I'm charging 100, the market rate is 100. If I'm charging 50, it is the market rate. So I'm moving with the market, not having a historical cost or historical inventory kept and valuing it at the cost that we bought it at. But the disadvantages are that the method can be cumbersome to operate because it sometimes results in several batches being only partly used in inventory records before another batch is received. So here you can see that in this example, the previous batches were available. The previous batches were available, but we were not using them because we had new inventory. So this is a disadvantage. And in the previous inventory that was kept with us, it could go obsolete, it could go bad, it could rot, whatever it is, there can be a problem for that. So we should use the older inventory first before using or touching the new inventory or ordering it. Now, LIFO is often the opposite of to what physically happens and can therefore be difficult to explain to managers. So it is difficult to explain because it is normally not happening in the market. And as compared to FIFO, decision making can be difficult because variations are present in the price. But in FIFO, we are directly using what was coming first. Here we have to see what came last, and according to the price, you have to adjust the cost of goods sold, and we have to adjust our units in the market. So it is difficult to operate in this domain with these fluctuations in mind. Now moving on to weighted average cost of capital. What weighted average cost of capital basically says, it tells us that we are basically having an average cost of investment. Here we are simplifying everything for our managers. We are doing what? We are doing basically is that we are transforming the cost and spreading it equally among all the inventory. So the formula says that the total value of inventory that's already present plus the cost of new purchase divided by the total quantity, that means existing and the new one. So total cost divided by total number of units give you an average cost. Each time a purchase has been made, we take out a new average, and the new average rate is applied upon the units. So average rate is very important. If you miscalculate it, your weighted average cost of capital is going to be a disaster for you, and it won't be a viable option to work upon. So ACCA calculates the weighted average cost for each batch of inventory. A new average cost is computed each time materials are received, or basically we can simplify it, purchases are made. Let's see an example. So the previous example that we did in FIFO, it is being carried out. It is being followed simultaneously. So here we are saying that we bought 400 units at the rate of 60. Are there any prior units? No, they are not. So we are not going to take out an average here. The average rate is 60 here. So 24,000 is the cost. It is mentioned here. The average cost is 60. No issue. Now we have issued inventory. Will we calculate the new average cost? No, we won't, because we have not purchased it. So in this step also, when we're issuing 200 units at 60, the average cost is the same. But now you see that the average cost has increased in the next part, where we are buying 300 units at 70 and the total cost is 21,000. So now we have 500 units in total and the total cost is 33,000. So if we are trying to understand how we got these values, the value of inventory before this purchase was 12,000. How many units did we purchase? 300, and the cost was 70. That makes it 21,000. This is the total cost of previous plus new inventory. Now the number of units existing were 200 and new are 300. So you can compute for yourself that 33,000 divide by 300 makes it 66. Okay. So 66 is the new average price with the new purchase. So the trend I'm trying to make you follow is each time a purchase is made, we have an average price. You can see here, an issue of 200 units was present. We will issue it at the new price or new cost, that is 66. So till we are issuing something, is the price changing? No, it must not. As soon as we purchase some new units at 80, the price goes up to 73. Same procedure how 19,800 was the old cost plus our new of 24,000 and divide by our 300 plus 300. So that makes it to 73 per unit. Now the next units that are going to be issued will be issued at 73, whether be it now or 2 months later. The average price won't change. If you want to calculate the price of or the values of issues, you can add all the issued column values, total values, and you will get your answer. And the closing inventory, we have 73 per unit, and the cost is 200 units are present. So 14,600 is the closing inventory as follows. So this is how we are using weighted average method, where we're trying to take out the average of all the units and we are basically just applying it all over the inventory, whether be it last year's inventory or this year's inventory, whatever situation it is, we are not concerned about it. We are just using what? We're just using the average rate and we are issuing inventory in the market. Now, the key insight here is that AFCO smooths out price fluctuations and results in values between FIFO and LIFO. So the differences, the problems that were faced in FIFO and LIFO are eliminated here. The advantages are fluctuations in price are smoothed out, making it easier to understand data, easier to make administration, as bit administered than FIFO and LIFO. FIFO and LIFO needs a lot of practice, lot of knowledge. Here we can easily identify it, calculate it, review it, that what is happening in the organization. Because there is no need for identification in each separate batch. So no separate identification makes it easier for us to calculate the cost and apply it on the particular domain or particular areas. The disadvantages include the result issuing price rarely an actual price that has been paid. So the cost of the units that you have bought earlier on is low, but you're valuing it at a higher price. So that might not be allowed in some situation, but it is allowed by IFRS, but it is not giving you true and fair picture. So that is not a very good method to operate on, where you are not giving the true and fair picture to your employees or the stakeholders of the company, and can run to several decimal places. So difficult to interpret. Then we have price tends to lag a little behind current market values when a gradual inflation occurs. So if inflation occurs, a part of that inflation is going to be applied on the inventory, not the complete one. Let's take an example. If I tell you that we have inventory of 100 and an inflation of 10%. So 10% inflation basically does what? Inflation increases the value of inventory. So we had inventory of 100, 1 unit of 100 and second of 110 due to our inflation. Now, if I average it out, that makes it 210 if I add both, and we have bought 2 units. So it makes it 105 per unit, the weighted average cost. So if the weighted average cost is 105 and the market rate is 110, are we applying the complete inflation here? No, we are not. We are only applying a portion of the inflation, making it an ineffective method of valuing the cost. So this is how we see our periodic costing methods in our MA1 exam. So you might get a calculation of basic levels, you might get the assumptions, you might get the advantage, disadvantages. So everything is present. I hope you have understood the concept and you are able to attempt the practice questions that I'm giving. So we will continue on lecture in the second method of weighted average cost in the next class. So till then, enjoy learning. That's all from my side. Love.